Welcome everyone to our impromptu advanced webinar, Thinking Fast and Slow When the Rules Collide. Thank you everyone for being here at the last minute. Great to see you all. Thanks for coming out. We are recording this session. We'll have it on YouTube, Vimeo, and of course at jdaltontrading.com under webinars. So any questions, type them in. We'll get to as many as we can, and I'll turn it over to Jim. Hi, Jim.
Hi, thank you. Let me make a couple comments before we start. There have been several people have emailed us or called us and said that business-wise, they don't think we're the hottest thing in the world because we give too much away free, and we are aware of that. But our view is that it works out in the end. The presentation we're going to do today really has a lot to do with the emotional side of trading, and so I'm going to do the scheduled emotional side of trading first. Then we will go in and we will review today, and we'll take a look at expectations for tomorrow. So we'll really bring it into two different segments. What I really want to talk about today is Thinking Fast and Slow, which is a book by Daniel Kahneman. That's a book that we recommend highly. There's another book we recommend too, and it's called Habits. But Thinking Fast and Slow really addresses that as humans, we have a very fast way of thinking. I mean, this is how we get up. We get dressed in the morning, we drive the car, we back it out of the garage, and we do these things that appear to be effortless. And we do a lot of that in trading. It's not always right. But then we have slow thinking, and slow thinking is where it's a deeper type of thinking and a deeper type of analysis. The brain is basically lazy. And a lot of times the brain will take over and do the fast thinking. And the faster you think, sometimes the more errors you're prone to make. And sometimes we have to be very careful to make sure that we consciously override the fast thinking portion of the brain in order not to follow every impulse that we've ever had in the marketplace. So what I'm going to do, I'm going to show you how my emotions were extremely high when the market opened on Monday morning. And we'll show you how three of our rules came together and kind of collided and took things to an extremely high emotional level. But let me set the background for you first. For those of you who get our written report, we put out a written report for those that are signed up for the next Mastery Series, and also part of that is the Kickstart, which are the 7 webinars we do in preparation for the Masters Series, or those that have been members or are members, and you become a member of J. Dalton Trading by having, purchased one of the videos or have participated in one of the past intensive programs. Right now, as we get ready for the start of the Mastery Program in the beginning of May, we are issuing 2 reports a week, one on Sunday in order to prepare you for the week, and then we update that on Wednesday, which I'll have to update tonight for tomorrow after we get done with this program. For those that got last weekend's report, at the end of the report, I had a box down there and it said disclosure. And the disclosure was, I stated in the disclosure that I had gone home long puts on the weekend. And I said, this is something I don't do very often because your risk is substantial taking home puts that are going to expire the following week. And you're going to lose the time premium from Saturday and Sunday. So it's a high risk situation, and it usually is not wise in order to take a trade home, take options home over the weekend. However, I did it, and I'll show you why in a second. Another thing that we talk about, and this also has a lot to do with emotions, and that is too many times traders go out looking for a trade. And our comment is, if you go looking for a trade, more than likely you will find one, and more than likely it will not be the trade that you want. My recommendation is let the trade come to you. Now, a lot of people, they say, well, what does he mean by that? If you've never felt the position where you've been watching the market, having no particular trade in mind, and all of a sudden you see the trade develop, you see the trade come to you, and you then execute that trade. Unless you've done it, it's pretty hard to have a tangible grasp of what I'm talking about. But that is what you are striving for on your trip to become a successful trader. Now, I'm going to go back and I'm going to show you what that trade was for me coming into the weekend. We have been following the level 2332 for some period of time. There was one low there, two lows there, three lows there. There was an overnight low in here sometime, so that made four lows there, and five lows there, counting the late break last Friday. When I looked at that many bounces off of that 2332 level, I thought that it was very unlikely that that was going to hold up any longer. Now, that's a gamble. That's a lot about what trading is. But it seemed to be an intelligent gamble. I mean, I was aware that the healthcare bill had been pulled on Friday afternoon, and that's what brought this market way down, touching that 2332 area again. And I think the market got too short late Friday. Then, of course, coming into the weekend, it bounced. And the other money didn't have much time to react to that. So based upon having been down there four times during the daytime frame session and once in the overnight session, or a total of five times, I thought it was a good risk to take. So I went home long puts. So at that point in time, I wasn't terribly nervous. I thought pretty good chance we'd take it out. But what I want to cover with you now, and I'm going to go back, and let me go back to the slides. I've given you the background. We have three rules or guidelines that we use very often in order to be able to position ourselves to trade. One is the spike rule, and the spike, for those that aren't terribly familiar with it, it's a late afternoon price probe, but it happened late enough in the afternoon that it's hard to really judge if that spike is going to be accepted or rejected. I assumed, or I made an arbitrary judgment, that the spike ranged in the area that you see right here, and it would have been down just slightly below the 32 level. So the spike rule is, if the market opens above the spike the following day, that's fairly positive because it shows that the spike was rejected. If price opens and trades within the spike, that's fairly negative because it's showing that price spike was accepted. That lower price was accepted, not rejected. And the most negative is, is opening down below the spike. Opening down below the spike, the message that we take from that is that prices had not gone low enough when the spike was created to cut off the selling. So therefore, and I don't mind, I use the word negative because I don't like using the word bullish and bearish. There's too much emotion involved in those, and they're like, too many people take them as absolute terms. And I think that's very dangerous. So I say that when it opens below the spike, it's negative. Okay, so that's one of the rules. The next rule is the gap rule. And the gap rule says that go with all gaps that aren't filled fairly quickly when the market opens. So the opening on Monday, here's the overnight range, and the opening it's covered up here, but it's the opening was, I will see it in, I'm sorry, this is the overnight inventory. We'll see opening in the following slide. But we gapped open on Monday. So now we're below the spike, which is negative. We've got a large gap to the downside, which is negative. And what we also say about gaps is the bigger the gap, the lower the odds that that gap will be filled on that day, because the lower the gap, the more dislocation there is in people that have to meet margin calls, price-based systems that kick in, etc. Then the third rule or guideline that we're dealing with is overnight inventory. And we say that about 65% of the time, the trade following overnight inventory, about 65% of the time, the market will trade opposite the direction of overnight inventory in order to allow that inventory to come back into balance. Overnight trade is very often done by weaker hands traders. So the spike rule was negative, but it was really way down. The gap rule was negative, but it's way down. And then when you look at the overnight inventory was 100% short. If you look up in the left-hand corner, that is Friday's settle. Here's the high on Sunday night. Here's the low. So you can see it was quite short, so 100% short. Now, with this in mind, what I'm saying is these three rules collided all together on Monday morning. As you know, I came in with long put position. Now, what I want to share with you, and I'm kind of embarrassed to share this because I've been trading for a long time and I've been through a lot. My emotional level as the market opened on Monday morning was extremely high and kind of out of control. And here's what's going through my mind. Oh, if I get out right here and the market continues on down, boy, I'm going to really feel bad. But boy, if I don't get out right here, and it may take all my profit back. And then I'm saying, well, the gap rule is negative. The spike is negative, and my emotions were just extremely high. One of the things that anybody that has been with us for any period of time has heard us say, anytime a thought like, if I get out here, I'm going to really feel bad if the market continues lower, or any of those utterances, once that comes out of your mouth, or the thought even goes through your head, you've got to go to a neutral position because you no longer have any chance of being objective. Also, what popped into the first thing is I'm going through this emotional thing as we're nearing the opening and I'm seeing what the opening is. As I'm going through this, all of a sudden, a kind of a calmness settled over me. And having read and talking so much about thinking fast and slow came into my mind. And it became very clear to me that I had to go neutral. I had to get away from the fast thinking. I had to get to the point where I could engage in slow thinking so I could really do some analysis. I went to the machine. I sold 100% of my put position. I was 100% out of the trade. My emotions came back into line. And then maybe this was nagging in the back of my head before, but so many of you have heard us talk about the 45-degree line and traders being short in the hole. Well, clearly, when the market's down as far as it was on Sunday, we know that traders are going to be short. But when I looked at the profile from overnight, and remember, I don't usually put a lot of faith in the overnight profile, but that's saying usually. When I looked at the profile, this was, remember, after my position was 0, I looked and I said, okay, there's half back. The market broke down, balanced along here. Then it broke hard. That established, when it broke to that low, and when it broke to that low that we're looking at, I'm sorry. Okay, when it broke to that low, that established the half-back level of the overnight range. When I saw, following that low, that the market rallied to exactly half back and sold off again, I now have a pretty good idea that the trading that took place at half back was extremely mechanical trading. Smart money doesn't have to wait till the market goes exactly to half back before they sell it. Who does that? It's usually weaker hands traders. The market broke again, after it broke, and it came back up. There's the first low, back up to half back, then down again to half back. And I'm watching and I'm seeing this 45-degree line. The 45, the point of control for the overnight session is, as you can see up here, about where the line is. It's also half back. It's just a little bit, half back is just a tick or two above the fairest price or the point of control. The point of control is the fairest price at which trading is being conducted. So when I looked at this, I'm saying all of this trading, more trading took place below half back than took place above half back. And I'm saying it looks to me like this market is just tremendously short in the hole. Short in the hole means short at poor prices. Traders are short. They're short way below value relative to Friday, but they're short in the hole relative to Sunday night. And once I saw this, I knew there was no way that I was so happy I was out of my position. My anxiety went away, and I said, well, I think we got a pretty good chance that this market's going to have to rally to relieve that short inventory position. The market opens. You can see the opening, the black dot. It goes down to within a tick of the overnight low. Then the short covering rally gets underway. Then the market, you get an inside bar in B period. You get an inside bar in B period. And one of our day time frame trading rules is, go with the breakout from the inside balancing bar. Balance and excess are the two most important concepts we deal with. The market then broke to the upside. And as you can see, at one time frame higher from the opening, 1, 2, 3, 4, 5, 6, 7 periods. So at one time frame higher for 7 periods. The volume was low. The volume was low. And it was very, very sluggish. However, that's what was going on on that particular day. Now, something else took place, and I'm going to go back. I'm going to go back to my profiles on that short covering rally. Remember, we said it went, let me split this out. 1, 2, 3, 4, 5, 6, 7. So it one time frame higher for 7 time periods. I'm sorry, 8. 1, 2, 3, 4, 5, 6. I guess that's 7. 2, 3. This is the 7th one. Now, what I want you to notice, there is the top of the spike. Remember we pointed out that spike before? And I think we had the spike right there. Notice that the M period high was 1 tick below the top of the spike. Now, at that point, after the market's one time frame higher all day long, volume has been declining relative to Friday. Market was very sluggish, and it's very easy to get negative on that market. The market then broke, notice the level it broke to. That would be 23.3250. And we've been using that 32 area, that mechanical level. So what do we have now? On the break in the afternoon, we have a break back to the level we've been using. That's on the low in the afternoon. We have a high 1 tick below the top of the spike. So again, we're locked into 2 very mechanical references. Now, what that tells me, and the fact that we got no follow through overnight, what it tells me is that I still see a market that's being boycotted by the more serious money or the longer time frame money. When markets go to these absolutely mechanical levels, it's usually an indication that what we have is a lot of emotional trading money dominating the market. Now everybody wants to say, oh, where's the other time frame? Where's the other time frame? Did they come in here? Did they come in? My comment is basically, I think the other time frame or the longer term, more serious money is absent from this market. And I mean, when I say absent, they're always doing something, but they're not dominating the market. The market is being dominated by shorter time frame traders. Once you know that, then there's going to be different characteristics you look for in the trading. One of those characteristics is going to be that the market very often goes to very visual or mechanical, synonymous terms. When I say mechanical, I mean it's going to something that's very visual. Anybody can see it. You know, there's no math or anything else. It's right out in front of you. So that's what's going on in this market. And so what do I think happened on Sunday night? Did the market break? Yes, there was a tremendous amount of knee-jerk reaction because the health care bill was pulled. We had what I thought was an unsustainable support level at the 32 level that was taken out. Short-term traders, afraid they're going to miss the biggest move to the downside that there's ever been, piled on to that market. And then when the market came back to half back, they piled on again. Came back to half back again, they piled on again. So feel the emotion going on. Feel what the people that you are competing against every day are doing in the market. This is how they get into trouble. Now, you can trade with them as long as you understand that and you exit. You understand what they're doing and you exit before they get caught or trapped. But that's what was going on in this market. So let's go back and review the importance of emotion. The things that we say, the market is market understanding, plus your self-awareness. Market understanding includes some of the structure and the mechanical levels, but it includes understanding the people that you are competing against and what they do to form that structure in the market. The self-awareness has a lot to do with you being able to recognize what those people that you compete against on a daily basis are doing and not get yourself caught up in some of the silly things that they do. Now, early on when they start trading on Sunday night, it's fine, but they take it to excess. So the emotions are, first we have the emotion has to do, when I said on Friday afternoon, letting the trade come to me. I had no intention whatsoever of going home short on Friday afternoon. I was here, I was watching the market, and when this developed late, and all of a sudden it came to me, and it appeared to me that the odds were very low that the 32 level would hold, and very good that it would be taken out, and I would get an excellent chance to decide if I wanted to stay or take off my position. So, and that actually was a fairly low level decision. I wasn't terribly emotionally involved. That, it was there. I thought it was an opportunity. Taking intelligent risk is what trading is about. But then we're coming back, and the next thing we're dealing with the emotions of the people we compete against. And then I'm kind of making fun of them, getting in trouble. But then when the market opens on Monday morning, I see it's going to open, I realized that my emotional level was extremely high. And I had made one mental mistake was, if this market went down to a level I had been talking about, boy, that would be a huge profit. As it was, where I came out was only about a third of what the maximum potential might be. So I'm like, oh boy, I'd hate to come out, but I feel stupid. So I recognized my emotional level. I exited the position, reflecting on thinking fast and slow, reflecting that knowing that once I have these wild thoughts, I no longer have an objective bone in my body. I came out of the trade. I preserved my profit. I had a very nice day. I was able to add to it a little bit later. And it was, it worked well. It worked the way it should work. But there's a lot of information in what we're talking about. And the reason I wanted to do this impromptu session was because I thought it was so important to talk to you about the emotions. It's easy to say, well, here's support level, here's a 45-degree line, and, here's the market's one time frame. Some of those things are a lot easier to talk about, and they're not as ambiguous. When we get into talking about the emotions, it's far more ambiguous, and a lot of times traders don't understand that, I have those same feelings, and sometimes they may even be far greater than yours, but they are a real part of learning to trade successfully. Market understanding, self-understanding. So I wanted to go out and I wanted to do this because I wanted to be able just to discuss that emotional element with you. Also, when this market, noticing that in the afternoon, that the high was mechanically at the base of the spike, which is resistance, sold off. What I really wanted to do, I really wanted to get short again. I thought, boy, coming up during the day, there wasn't any volume, the market was sluggish. I really wanted to get short. And I got a little bit short. But then when the market came down, and it was about 4 or 5 ticks above the J period low, I was talking to a friend of mine, and I said, you know what? I'm packing it in. I covered the position. I'm going for a walk. And I left for the day because I'm watching it being sluggish, coming right down to this mechanical level once again. And traders do what works until it doesn't work anymore. And that's been a very good number for them. So I took a little bit of profit off of that. I walked away for the rest of the day. And so you see that held. Late in the day, you see the market did come back up through that exact or mechanical level. So there was a lot of information, even late in the day, to be able to understand and appreciate what was going on in the marketplace. Now, before I go in to talk about today, I'm going to do a little commercial because we've got the intensive starts, not the intensive, the mastery series. There's two portions of it. First one starts in May. Second one starts the 1st of August. So it's a total of about 100 days if you take the whole package. But what we do in that session, you get a report at the end of each day, get an update in the morning, but throughout the day, there's a one-way chat function. And throughout the day, I'm making posts to the chat. It's one way, and it's one way so that it doesn't get all clogged up. And a lot of professional traders, they don't want to read the two-way garbage. They just want to hear what my comments are, and they'll take them or leave them what they want. So if we were in the Mastery Series, and if I was putting chats out, these points would have been clearly, well, I hope I would have, clearly put onto the chat page so you would see the comment, you'd see what I was looking at. And what we're hoping to do as we go through this program is we don't tell people, our game isn't to tell you where to buy or sell. That is up to you. And everybody's going to do it a little differently. What I hope that we're able to do is bring you to a way to think about the market. How do you think about the market? How do you process this information? And we do that by doing the report at the end of the day, recap report, and a review for the following day, an update in the morning, and then the continuous chat throughout the day, comments, to help you continue to internalize. And trying to internalize the information is really so very difficult. It takes a long time to get that information. It's one thing to see it. It's one thing to recognize it. It's another thing to internalize it. And by hearing it and seeing in action over and over again, you do start to build new habits. Okay, so we've covered section 1 of today. I've done the commercial. Now, let me ask, are there any questions simply based on the portion that I have covered so far? I don't want to go into today. I will later, but right now I only want to cover what we have talked about so far. Julia, are there some questions?
Sure. Yes, we have them. Jim, I was unable to get long on Monday because of the weak low. B period bouncing off half back, D period closing the breakout gap, and E period bouncing off exactly at Friday's low. What am I doing wrong in my thinking? Am I weighing these too much?
Okay, that is a really great question. And it also is a question that ties into the emotions that we're talking about. A fuller analysis would have, if you'd gone through and think about the overnight inventory relative to the short, think about the odds of a short covering rally because overnight inventory was that short. And then, and let me put the overnight in. And remember another thing that we talk about, if you're going to do a trade, you need to have some place where to put the stop. So you had a couple points. The market opened, it came down to the low, did a little bounce, came down again. When it came back through the opening, that's a legitimate place to go long because you know the inventory is short. Your stop would be someplace down below the overnight low. Now, if you were frozen on, it is so exact because it's exactly at the overnight low. I understand that. I looked at that also. But my thinking, I'd gone through the process, so I knew how short the market was. I also know from experience, and we've talked about it, that it is not uncommon when a market is too short to go to an exact reference. And the thinking is like this. Those that are short, they're thinking, oh my golly, we've got the best they hope to get out of, I can just get me out at the overnight low. So it's not uncommon for a market that is too short, such as yesterday's, to stop right there. Now, if you missed that trade, if you didn't get it right on the low, when it came back through the opening, that's another opportunity. Or you have another opportunity, and that is when you had the inside bar, when you broke from the inside bar. Now, I understand that seems simple now, but this market came back so far in D period that made that a hard trade. But the thing, your question is a great question. It's a real question. It's those things we face every single day. Part of the thinking was, did you have a place for a stop? Yes, you did. Then you think about what is the risk reward? The risk reward was very large. If you thought about where would I put my stop, and you say, if you get this short covering rally, there's a good chance that it goes all the way back, which it did. And then you sit there and say, okay, is the risk reward worth it? So anyhow, it's a great question, and I thank you for it. Another question, Julian.
Jim, as you were suggesting Sunday night low, which was held on the Monday real-time or the pit session trading hours, is a weak low, or as you are suggesting, is a weak low. Does that mean that low needs to be tested again, or because there are single prints in the A period, suggests that it is a strong low?
It's another excellent question. It is both a good low, and a good low is described as a low that has single prints. It is also a weak low because it was only a single tick from the previous low. So, but again, it's one data point. One of the things that we haven't, the phrase I haven't used yet, and I should have used it, the market always has to take care of current business first. The current business yesterday morning was that the market was too short. It's like running any business. You have to take care of the business at hand first. You own a retail store, you got all kinds of things you want to get cleaned up, but you open the door and there's 5 people outside. Well, you don't ask them to wait while you go and clean up your store. You take care of the 5 people outside. Got to take care of current business first. And we have a phrase, carry information forward. So I am carrying this piece of information forward that it is a poor low because it's so mechanical, one tick from the previous low. So your point is well taken. It is a good low because it's single prints. It's a weak low, both, because it's one tick from it. It is a piece of information that you carry forward. And when you carry it forward, what you have a pretty good idea that when the market comes from a mechanical low like this, it more than likely wasn't nice, new, strong buying. It was more than likely old business. Okay, another question. That was two great questions. Thank you.
Yeah, so it's fair to say that it's a strong or has excess in the daytime frame, but for the next higher time frame or down the road, it is it's a weak low. And
yeah, just don't overcomplicate it. When you look at it, you circle this, you carry it forward. For right now, it's a good excess low. It's a good excess low. Now, another issue with that. Once you got back above the 32 level, remember, coming on the downside, the 32 level, 23.32 level was support. Okay, so when the market's below that, it then becomes resistance. Once you get back into that area, since that 23.32 level marked the lower end of the trading range, which we have previously identified, and we identified it on the weekend, and we had the high at we had the trading range high at 23.57, even though Jim had a misprint. I wrote 37. It was a typo. It was really 23.57. I just took the base of the high of this upper distribution here, and that's what we were looking at. So once it enters this, it is amazing how often it finds its way back up here. Did I think it would do it? No, I didn't. but it went ahead and found its way up there. So this then becomes support again. So now the market rallied up to the, and we'll go back into the day in a little while, but take it a piece at a time. You have an excess low. You got back above resistance. That then targets the upper end of the range, and it made that upper end of the range today. So now we close back in the range. But so take the information a piece at a time, carry that questionable low forward. Another question.
Yes. Could you explain how you determine the top and bottom of a spike?
There's some arbitrariness to it. I just looked at the thin part of this market. I looked at the thin part and, where it was basically 2 wide, a little 3 wide down here. And I knew it happened late in the afternoon. And there probably wasn't enough time left to go back and really determine if that was good or, if it was rejected, accepted. Again, it's not a science. It's not a science. There's some artwork, and we have never said that trading is scientific. In fact, I think it's very, very interesting. I was looking at a report the other day. All these people, these traders, and all this money was spent on building algorithms and everything. And everybody says, "Oh, I can't trade. The algorithms are going to get me." Well, they were up at a high. They made a little over 8 billion. Now they're down to 1 billion because they were there for a period of time. One algorithm begets another algorithm, and all of a sudden, they're trying to make a science out of the market, and it doesn't work. So between all the money that was spent, my guess is a lot of these people now are, a lot of the latecomers in particular are now behind the game, all the money in the upkeep, etc. But so again, what I'm trying to say is trading still remains an art. It still remains an art, and that leaves a lot of opportunity for you and our clients. I understand it's tough, but there is opportunity, and it's good opportunity. Another question.
My question is, and it's just an example, suppose we had a day session high at 23.56, and during the next overnight session we had a high of 23.60. Then which range is more relevant to monitor for acceptance and rejection during the current day session as it unfolds? Which is more important range to watch? Pit session or the overnight?
That question, I had answered that question. It may be a different person asking that question.
I did put it, no, it's from the email. Did you answer it? It is.
No, I answered it by an email. I don't know if it's the same question. The question I saw that I answered by an email before, which is more important, the daytime frame range or the overnight range? And my answer was, it's contextual again. Yesterday, it was the overnight range. When you come into Monday, it was the overnight range. And, and because of the context, and the context, it was so short and everything else. And I said, overall, the daytime frame range is generally more important than is the overnight range. But there's always exceptions. And yesterday was an exception. Another exception is when the overnight range establishes, say, a new high, a new all-time high in a rally. Then the overnight range becomes very important. Okay, another question before we go on to today.
Yes, Mark in Chicago. I'm still not sure how you resolved the ruling reason early on Monday's start of regular session, the gap, the spike, and the overnight inventory.
Well, the one way that I resolved it is I took my position out of the equation. I found it very difficult to think clearly with the position on. Once I got the position off, then when I looked at the market, I looked at the structure of the overnight, and I said, this market is just unbelievably short. That's the 45-degree line, a very prominent point of control, and that was the conclusion I came to. But the first was to remove my position because I couldn't think clearly with that on. Another question.
Give me a sec here. How long? Oh, he answered that. Thank you for letting me know. What would have gotten you long after the S&P failed at the overnight low on Monday? How could you shift your mind to the long side even though you were negative, assuming you were already out of your puts?
I wasn't once I saw the inventory, I wasn't negative anymore. I got negative later in the day when I saw how low the volume was. The volume was and how stretched out the market was. I got negative again then. In the morning, and I would like to say, oh boy, I did a great job. I came out of the short and then I got long. And the truth is, I didn't. I was pretty emotionally worn down by the time I got out of the position. I mean, I was thankful I got out of the position. And I didn't make the mental switch as quickly as I should have. Had I had no position on, I suspect that I would have gotten long. One of the reasons that I like to use options, because I can buy some out of the money options and I don't have to have a lot of risk, and I can take some of the emotion out of the equation. Okay, but it's a great question, and I'd like to say, oh boy, I went from short to long. The truth is, I didn't. One of the other things that we talk about, we only have so much emotional as well as financial capital. This idea of emotional capital is overlooked by an awful lot of people. What happens a lot of times when you have used up your emotional capital, you tend to make some pretty crucial mistakes. And I hate to admit it, but I had used up a lot of my emotional capital by the time the market opened yesterday. I was not emotionally set to go long. I'd like to say, oh yeah, I had no problem. The truth of the matter is, and one of the reasons I wanted to have this webinar with you was that I wanted you to know the real feelings that all of us go through and the things that we wrestle with as traders. So many times traders are out there and they're thinking, well, they don't have those issues. Well, they know what they're doing. They've been doing this for a long time. That's just not true. I've never known a trader that is free from those issues. And all you have to look around. I looked the other day, and there was a I think it was Easton hedge fund that was closing down. There was a guy that was the youngest partner ever with Goldman Sachs, and he goes in, he starts a hedge fund, and he's got I think $14 billion or something. Now it's down to 7, and he's closing the fund. It is amazing. It is amazing how difficult it is to keep control of the emotions, keep control of your trading. All of us fall down from time to time. So, and what I'm trying to get at is so much of where we fall down has to do with emotions. Whether it's we won't give up a position we have because we're going to stick with it no matter what. But I wanted to share the importance of that emotional feeling with you. And I wanted to share this idea of emotional capital. Again, one of the things, and I'm going to switch, one of the things we say a lot of times is too many traders too often are too active during the first hour. One, sometimes it doesn't make any sense, but a lot of times we'll have traders that say they're struggling, but they did 4 or 5 trades in the first hour of the day. Up, down, up, down. They've expended all the psychological capital they had. It's something you have to preserve your psychological capital as well as you do your emotional capital. Okay, one more question, and then I'm going to go to today.
Okay, on most days with large gaps, inventory is very skewed in the direction of the gap, correct? Is it a fine distinction when to expect a correction and when not?
Okay. Remember that when we say we are not market profile traders, but we use the market profile to organize the data so that once that data is organized, we have a better way of assessing what that data is telling us. And when you're looking for an answer, when do I go with overnight? When don't I go with overnight? And the answer is not an easy answer. It's contextual. And that's why I tried to explain when I looked at the market, the overnight inventory from Sunday night, we know it's 100% short, big break, rallies back up, little break, rallies back up, breaks again. Here's the point of control. And I'm looking and I'm saying, it appears to me from the organization of this data that there's an awful lot of short-term traders that are caught short. Now, what might that overnight inventory have looked like if we really had serious money selling coming into Sunday night? You probably would have seen the profile much more elongated. You probably wouldn't have seen as many bounces out of it, and you probably wouldn't have this prominent point of control up here. Again, you have to think, and that's, again, what we're trying to do when we're talking about, being part of the intensive. We continually go through the analysis that we did today. And when you think about it, it's contextual. And then what happens so many times, and then the question comes back, well, when? Well, there is no simple answer. There's no simple answer. You have to think, and you have to do what I did. You have to make an assessment, and the assessment was it was too short. Okay, I'm going to go over and I'm going to talk about today. Again, that wasn't our intention.
Can I ask one question, Jim?
Sure.
I'm sorry to interrupt you. This gentleman, he said when we used to work on a trade desk, hold on one second so I can find that. When we traded on the desk, we were aware of T+3 and how it affects month-end inventory corrections. Do you think this is still valid? And I had to ask, what do you mean?
No, okay.
Let's know what that means.
I'm going to talk about that.
And the S&P 500 stocks. So month end is a great time to squeeze shorts. We used to do it on the desks all the time. We had a massive short squeeze last month end as well.
I said earlier, I wanted to only talk about yesterday. Now I'm going to go into today.
Okay.
And that question right there really ties into today.
Perfect.
Okay. So now, where I come in today, I was negative coming into today. I was negative because yesterday's profile did not elongate. It looked like the P formation, which is usually an indication of short covering, not accompanied by new money buying. Volume declined. Value was lower. So I was fairly negative. Matter of fact, when the market reopened last night in the overnight session, rallied up a little bit, I went back to a put position. And then the market broke down this morning. I covered those, made a little profit. Market rallied back up. I put them out again. And then there was nothing. When it was trying to go down, it just started to dry up. So understand, my position was negative because of yesterday's rally was on declining value or volume. Value was lower, and the point of control was very prominent. So it looked like old business, not new business. So I come in this morning, and or last night I put the position on, and I'm doing okay. Then all of a sudden the market's just not going down this morning, the second time. I said, okay, time to get out. Now, go back and let's take a look. Let's take a look at some things that happened in the marketplace. One, yesterday's low in the cash market, I believe the cash market low was about 23.05. And if I'm wrong on that, somebody's got a better number, please let me know. 23.05 on the cash market yesterday. That's kind of a round number, and it's not uncommon to find short covering and even trading money buying around an even number like that, particularly the first time back down there. So that's one. Secondly, we even though I didn't like the day, we did come back through resistance, had been support, it then became resistance. We came back through that. And then you always have to be aware that the potential for the market to trade back to the other side of the trading range, which we had identified over the weekend of being 23.32 to 23.57. So that's what it did today. Was I anticipating that? No. But do I know that's something that we would be writing up? So that's one. So one, we came from 23.05 in the cash market. Very logical place for shorts to be covered in, a very logical place for some trading money to come in. Secondly, the quarter ends on Friday. Today was the last day to buy stocks for normal settlement by quarter end. Now, the gentleman was talking about month end and squeezes and, trade day plus 3 type of thing. Does it happen? Yes, it does. Does it always happen? No, but it's certainly something to be aware of. So today I'm coming in 23.05, where the cash market came from. It is the last day to buy stocks and settle on Friday for anybody that wants to mark up an institutional portfolio. Then I looked over, and I'm going to go to crude oil. Crude oil gapped higher this morning. There's the bar chart for crude oil on daily. Crude oil gapped higher this morning. When I made the comment earlier that this market has been going to these mechanical references, as you saw yesterday, it pulled back to a tick or two above the mechanical 23.32 level. Early on, it went to one tick below the spike, the top of the spike. All these mechanical levels. What does that tell me? That tells me that I don't have a market being dominated by longer term money. When I have the traders in dominating a market, one of the things they've been doing recently, nothing else to go on, they run to crude oil. We had a day when the market broke very sharply. Crude oil was down $1.06 on the opening, or shortly thereafter. The market broke, came all the way back before the day was over. So again, I'm looking this morning. We didn't take out the 23.32 level. It held. We looked below the overnight low, came back in. Crude oil gapped higher, and it continued to get stronger. Then you had consumer confidence comes out the highest, best results in 10, 15 years, or something, and and then you're dealing with this quarter end. So the traders, once the traders get on, and I suspect that more than anything else, they got on board following the crude, because that's what's been going on lately. So I'm guessing that they got on board following the crude. And once they get started, the momentum traders just keep coming in. They just keep coming into the market. They buy, they buy, they buy. Now, for anybody that was on the Twitter, we tested out Power Lunch this afternoon, doing a half an hour on Twitter and answering questions that came in. And we will probably, for those that are listening, we will probably do that again. We'll do it a little differently. We'll be a little bit more selective in the Twitters that we respond to. We'll try and do a better job to make sure that the answers are more pertinent to a broader answer. But that was our first time at it. It was very well received, very active. But one of the things that I said in there is the market was going higher on declining volume for the second day in a row. And now let me go. I'm going to go to our site for a second. on our training site, I think this is available for members, there's the New York volume. And so if I look at the volume, this is early on. So the first 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 periods, we are going again on higher prices going higher, again on declining volume for 2 days in a row. And yesterday was overall low volume, plus it declined all day. And today we were going lower on declining volume. So I saw that as negative. And what I said, one of the Twitter comments that I put out there was that the risk to short-term traders being long was very high. Now, a lot of people don't really understand that. They think that means to short right away. Doesn't mean that in any way, shape, or form. It just means that the risk was very high. But what traders were doing, they're just inadvertently buying every little pullback. And that's what momentum traders do. That's the way they operate. So what happened, we got a little increase in volume, but we got the little increase in volume in the last hour, late in the day. So there was probably some selling into this late in the day. But overall, it was a weak day, even though prices went higher, even though we went back up and we got a prior poor high out, and we made to the top of the trading range. It was overall a relatively, weak trading session. And you can see that we did have a late break, and that late break was fairly substantial. That high on that period was 23.60.50. The late break took it down to 23.51, 23.51. So it was a late break of 10 handles. So again, when we're making that analysis today, we're saying, be cautious, looking at the market, looking at how strung out the market is, looking at the anomalies, meaning the rough edges along the way. There's an anomaly, there's an anomaly, there's an anomaly. That's usually a sign of emotional buying. And that emotional buying is very often not lasting. And then somebody want to know, well, what does institutional buying look like? Well, all I can do is say they don't butcher a market. They don't butcher a market. You get more of a controlled buy, let the market settle back. You get more of a wave-like action. This was emotional type of buying. They got crude oil up, and you still have shorts in the market probably from yesterday, and you got back above the resistance area. And so those are the things that happen in the market, and particularly when, as I've said, I don't see any indication of any meaningful adding to or subtracting from the longer term money. And then you tie in today as an unusual day because it is the last day that somebody said T+3, trade day +3 for settlement for positions people want to have for the end of the quarter. Okay, so now for tomorrow, and I was going to keep this very short, but we went quite a ways. For tomorrow, one of the standard things we talk about for references is the afternoon pullback low, which is at 23.51. When we come into the following day, how do trading is about change. If the market tomorrow stays above the 23.51 level, then we don't have any change relative to this afternoon. Now, we may open and trade up here. It'd be no change. There might be a trading environment. If we open and trade down below this level, we do have change relative to this afternoon. Trading is about change. Now, let me show you the last time we made a comment like that. And it's a standard comment that we point out all the time and talk to people. And we had the pullback low on this big trend day was right here at the end period. And you see in the following day, I'm not sure is that the day I'm looking for? No, it's not. I'm sorry. That's not the day I'm trying to go to. Let me go over here and get the right day. Okay, the day I was referring to, this everybody was, oh, this had a poor high. This was the all-time high as of right now. The pullback low in the afternoon was right there. We made the same comment that we're making today. Trading is about change, et cetera, et cetera. What did we do? The following day, we opened just about unchanged, looked a little above it, and then the market traded down below the pullback low from the day that made the all-time high. When that happens, we're saying, okay, there's change relative to the previous day. Trading is about change. Well, from this period of time, the market then 1, 2, 3, 4, 5, one time frame lower for 6 days. Now, while we're here, I'm going to go show you something else. And this trading's not easy, but if you get to the point where you will be calm, learn how to observe and look at a market, you will find that these markets are tradable. Okay, we were on another webinar, we talked about this, but here's the day we just looked at. We said the following day, if we open below the pullback low, something has changed. So then the market, one time frame lower. Notice that this, you can put a trend line almost perfectly on this high, these what? 1, 2, 3, 4, 5, 6, 7 highs, I think it is, 7 or 8 highs. Almost put a perfect trend line. So now I just made a comment that I don't see any indication in this market of longer term money on either the buy side or the sell side. What I'm seeing is the market that's in the control and being very much dominated by day and short-term trading money. So the short-term trading money, they're selling as close to the previous day's high as they can. Well, guess what? Then they do, I think they do a gap lower on this day. Now you talk about, here's another way, short in the hole. They've got them down to the point where mechanical trading is close to this trend line as you can get. When I see that, that's not how smart or longer term money operates. That's how trading money operates. Now, the more this goes on, the more short-term traders that don't understand what's going on, the more risk they take, the more comfortable they feel trading, shorting the market. 1, 2, 3, 4, 5, 6, 7 days. Bang, all of a sudden they're caught and it takes out 1 high, 2 high, 3, 4, 5, 6, 7 highs in one single session. Okay, but these things are understandable. If you were part of the Masteries program and doing a report, we were talking about this, we'd be sitting here and you'd hear words like, be very cautious. This is fitting a line. It hasn't started yet. But once it does, it's very likely you'll get the firecracker effect. And I get 42 questions. What's the firecracker effect? The stops from this high trigger the stops from this high, this high, this high, this high, this high, this high, etc. Okay, I'm going to show you that same concept in a much shorter version. These concepts that we talk about happen all the time, all over the place, and the markets, if people will listen, come into the mastery program, stay with us day after day, or you can put up almost 100 days or better. Let this internalize. And this is what's confusing. Yesterday, I told you that as soon as the market reopened last night and did a little rally, I went short again. What was I looking at? 1, 2, I've got 3 lows at exactly the same level. What kind of money buys at exactly the low of the last 30-minute bar? Is that strong money or is that weak money? Well, now, so last night, they take the market late in the day, they take the market higher. Let's spread out overnight. They take the overnight quite a bit higher. Okay, So, but if you understand this is down, I understand it's a pretty good chance. Now you say, well, Jim, why were you buying puts in here? Because I thought there's a pretty good chance we're going to come back down through this. Well, guess what? They gave me the trade, and look what happened. These mechanical levels, bang, you hit the stops, and that was basically it, you know. But those are the type of things, and there's no set rules. What we're trying to do when we go through these programs, again, we're trying to help you learn how to think about a market. Too many times people want to know, and these are the questions that, you know, most people have been with us for any period of time. No, you really don't want to ask that. You'll hear Jim start to cringe. People say, where do I get in? Where do I get out? Where do I put my stop? That's a mechanical approach. Somebody just tell me what to do. That is not what we're about. You can't, when this program's over, when this educational program's over, you can't take that with you. What you can take with you, and it's yours forever, is learning how to think about the market, learning how to think about trading, learning how to think and address your own emotions. That's what we're about. Anyhow, again, you can see the series. So we have the Mastery Series right now. We're in the Kickstart. And I think, is tomorrow the third session of the Kickstart program, Julia?
Yes, 12 p.m.
So we're doing 7. They're recorded. But we're doing the Kickstart program. It's a freebie to prepare you for the Mastery Series in order for people that aren't as familiar with what we do to bring you up to speed so it is easier for you to understand what we're talking about once the program gets underway. So once again, let me say thank you very much for joining us on this impromptu session. I hope you found it of value, and I hope you decide to join us for the Mastery program. So thank you.
All right. Thank you, Jim, very much. Excellent. Well done. Thank you, everyone. Great questions, great participation. Always makes it better. We're going to have this recording posted. Someone asked for tomorrow, where do you think the ES will move? Well, if you email us, I'll make sure you get the report for tomorrow, and Jim will have it written up in a comprehensive discussion so that you can understand where he's at for tomorrow's trade. 3 scenarios are always furnished in the reports. It's part of the Mastery Series and part of the learning process and part of understanding how Jim views markets. It's not predicting, it's odds. So go ahead.
I can't help but comment on that question. Those are the kind of questions that just kind of make me kind of get upset. Remember, we don't know. But what did we get done saying? Trading is about change. If you've got the pullback low from this afternoon is your reference to judge what the market's going to do tomorrow. We don't know the answer. We don't know what's going to happen overnight. And that's just it's just not something that we do. But you do have, we've talked about the reference, which is the pullback low, because trading is about change. Anyhow, I'm sorry, I couldn't resist that. Thank you all once again.
Okay. I'm trying to get my last messages here. A lot of great feedback. Thank you for your appreciation. And we're going to have this up on YouTube and Vimeo and at jdaltontrading.com. If you want to be in the Kickstart webinar tomorrow and you're a JD member, or you just want to be there and you're contemplating the Mastery Series, please email us and we'll make sure you get that. The reason why we keep it to just our clients, we're not trying to be exclusive. We try to include everyone in what we do, but we want it to be individualized as much as possible. And the smaller the audience, the more questions get answered. And these are people that are a part of the program and working at it and investing their hard-earned cash in it. So that's why we try to limit the amount of people in these webinars. I hope we don't cause any offense. We're pretty all-embracing group here, but just so you're aware of where we're coming from that. We don't want to seem exclusive. And I think that's it. So thanks, everyone. Fabulous questions. And thank you, Jim. Really great.
Thank you.
And we'll see you tomorrow for the 12 p.m. Kickstart. And if you are in the Kickstart program, you should be getting a report this evening, so please shoot us an email tomorrow morning if you do not have it. Okay, thank you, everyone. Have a wonderful evening, morning, wherever you're at, and we'll see you back here next week Actually, I'm sorry. I'm confused. Tomorrow is a public webinar, the final hour, 3 p.m. Eastern. Thursday at 12 p.m. is the Kickstart webinar. So this webinar we threw in the mix has confused me. So tomorrow everyone can attend, okay? 3 p.m. Eastern, how to trade the final hour, and then Thursday, 12 p.m. Eastern, the Kickstart webinar. Okay, so God be with all of you. Have a wonderful evening where you're at or morning, and we'll see you back here tomorrow at 3 p.m. Eastern. Bye.